Okay, ladies and gentlemen, and welcome to this webinar brought to you by CITYINDEX. My name is James Chen. I'm the Chief Technical Strategist with CITYINDEX Group. Today we're going to be talking about setting stop losses and profit targets, or basically exiting trades. So today is all about exiting trades, and when you look at it, really it's all about managing your trade. So once you get into a trade, and we talked about entries on the last webinar, but once you actually get into trades, it's all about exiting your trades in terms of using stop losses, profit targets, dynamic stop losses, etc. So I'm going to go through all of that today. I'm going to give you background and my rules, how I look at it, as well as go over a chart or two just to show you exactly what I mean when I use the techniques that I'm using. Okay, so let's get started real quick. If you have any questions during the course of this webinar, please feel free to type them into the questions window. And I see someone does not have sound. If you could hear me, please type into the questions window. If you could type in yes. Okay, great. Great. Okay. A couple people, I guess, do not have sound, but it might be on their side because most people do. Okay, so let's get started real quick. Let me move this forward. Just a quick risk warning. As always, financial trading carries a high level of risk to your capital with the possibility of losing more than your initial investment and may not be suitable for all investors. Ensure that you fully understand the risks involved and seek investment advice if necessary. Okay, let's move forward. I think I've gone over this several times in the past. Again, my name is James Chen. I am the Chief Technical Strategist at CITYINDEX Group, where I trade, I analyze, and I educate. And I think most of you know who I am at this point. And just as a side note, we're going to have this recording up on the website by tomorrow, so you should be able to see it if you miss part of it, or if you want to listen to it again, or what have you. Okay, so let's move forward real quick. Now, just to quickly go over the educational webinars, again, for those of you who are new here, this is our Wednesday series of webinars. Every Wednesday at 8 o'clock p.m. In the UK, we have these webinars where we talk about different topics related to trading, different educational topics. Just to go through what we went through in the past, we went through an introduction, indicators, chart patterns, multiple time frames, high probability trade entries, which was last week. And today is the logical next step in that, which is setting stop loss and profit targets, which is basically exiting techniques. And we're going to be talking all about exits. Last week we talked about how trade entries are only half the story when you're trading. The exits are as important, or possibly even more important than where you actually get into the trade. And it takes a little bit more doing in terms of planning your exits. And I'm going to talk all about that today. And then next week we're going to be talking about emotions and trading psychology. After that, trading discipline. And then we're going to go through candlestick analysis, which is a big part of technical analysis, Fibonacci trading, which is one component or one tool or technique of trading. And then we're going to be talking about support and resistance, which is extremely important. And then trading with the trend, which is the way I trade. And then we're going to talk about counter trend and range trading, because oftentimes you'll see markets that are range trading, or markets that have reached extremes, and you're looking for turns in those markets. So we're going to be talking about that, all of that stuff in the next several weeks. And of course, this is going to keep going on an ongoing basis. So we're going to keep talking about different topics. Okay. Again, if you have any questions, please feel free to type them into the questions window. Okay, so today we're talking about setting stop losses and profit targets, or exits, or basically managing trades. And I can't stress enough how important managing your trade is. Okay, and the question, John, will there also be a webinar on trading strategies? All of these webinars that we're giving will incorporate trading strategies, including we talked about multiple time frame trading strategy a couple weeks ago. We talked about trend trading after pullbacks, etc. And I'm going to be going through a lot of different trading strategies in the weeks to come. And David, yes, the previous webinars are available all online. Just go to the website, our website at cityindex.co.uk, and then go to Learn to Trade, I believe. And then in there is an archive section of our of my webinars. Okay, my educational webinars. Also, every Monday we run analytical webinars where we have our different analysts, including myself, speaking about the different markets from all of our different perspectives. So, I'll be talking about the technicals primarily, and then we're going to have Ashraf and Ken talk about fundamentals and the stock market, the currencies, etc. So just to give you an idea for those of you who are new how the schedule works. Mondays we have analytical webinars. Wednesdays we have the educational webinars with myself. Okay. Okay. So managing trades, extremely important. How to do that, and a lot of people think that it's just set and forget. But that's probably the wrong way to go about it. Whenever you get into a trade, your work has pretty much just begun. Of course, you have to plan your trade entry out very, very carefully, and that's what we talked about last week, and how to actually trigger yourself into the trades using a breakout methodology. Okay. If you missed that, you could go to our website to look at the recording. But in terms of after you actually enter the trade, your work has not finished. There's a lot more to do. Okay, so in terms of that, we're going to look at how to set stop losses, how to use profit targets, how to use dynamic stop losses, how to use multiple positioning, how to use trailing stops, how to consider risk and reward, etc. All of that. Okay, so before we get to that, just very quickly in terms of technical analysis, why am I talking about technical analysis right now? Because especially as it relates to exits, to profit targets and stop losses, technical analysis is the tool to use, or the set of tools to use. Okay, you're not going to be using, or you're probably not going to be using fundamentals to set your stop loss and profit targets. That's why technical analysis is extremely useful for the exiting part of your trade, of any trade that you get into. So just very quickly about technical analysis, technical analysis, you have the same essential analytical factors for each market or instrument traded, and those tools and techniques are all on the charts. Okay. And technical analysis is good for determining trends, key price levels, and potential price turning points. Okay, and those key price levels, the support and resistance we always talk about, are extremely useful and important when you're trying to set your exits. Okay, so again, good for determining trade entries, exits, and risk management. And I put risk management under the umbrella of exits. Okay, so exits is not only getting out of a trade at a profit, it's also getting out of a trade to cut your losses, to manage your risk. Okay, etc. None of this other stuff really applies to the exits, but we use the tools that we have, and I'm going to show you these tools today as it relates to a trade exiting. Okay, so I just wanted to give you a broad overview of technical analysis, why it works for, especially for the exiting feature of your trade. Okay, components of trade exits. Okay, so what do we have to consider when we are looking to set or looking to plan our exits from any trade that we get into? Well, first of all, you get into the trade, as we talked about last week, probably, or the way I do it, on a breakout methodology. Okay, so you look for a breakout, it gets you triggered into the trade. Of course, this is after your strategy tells you that you're going to get into the trade. So after you get a signal or an indication from your strategy that you should get into the trade, what I usually do is I wait for a breakout in order to trigger me into that trade. Then, right when you get triggered into the trade, then you have to consider your exits. You have to plan your exits very carefully. So what do you have to consider? Well, first of all, your initial stop loss. Now, when I say set or manual, you could set your initial stop loss, of course, as we all know, on the platform, directly on the platform. So once you enter into a trade, actually, while you're entering into a trade, you could set your stop loss right then and there. If you don't want to do that, you could enter your trade first and then set your stop loss there. I mean after that, okay? If you don't want to do that, as a lot of people don't like to set their stop losses, don't like to put it into the system for various reasons, okay? I almost always put in a stop loss, but a lot of people don't like to do that. You could also put in, not put in, but you could also manually or have a mental stop loss, which means that you have a certain level that you know that you want to get out of a trade, and then you'll manually get out of it if that level's hit. Now, there are several reasons why I do not recommend using mental or manual stop losses. Number one, and this is, it's pretty much one reason. Number one is that you don't want to, or you need to have extremely strong discipline in order to adhere to your mental stop loss. Okay, so let's say you have a stop loss at, let's just pick a number, 100, okay? Let's say you get into a trade at 110. Okay, this could be any market. And then your stop loss is at 100, let's say. Okay, and you have a mental stop loss at 100. Well, let's say the price goes down. Okay, so it goes down. It goes down to 105, then it goes down to 101, and then it goes down. And then you're thinking, okay, I'm going to get out if it gets down to 100. That's fine. Okay, so then it gets down to 100, and then you're thinking, this is going to bounce back. It's gone too far, too low, too far, too fast, okay? It's going to bounce back at some point. I'm going to stick it in there because it's going to go up, at 100, or even if it dips a little bit below 100, it's going to come back. So then it goes below 100. It goes to 99, 98. At that point, you start sweating. You start getting nervous, but you're thinking, oh, I'll just get myself out of the trade if it goes to 95, okay? And it's going to bounce back before then. Of course, it keeps going, okay? And at that point, you have a very bad situation on your hands, okay? So you need to, if you are going to be setting mental stop losses or manual stop losses, you will need to have the discipline in order to act upon it. If you do not have the discipline, it's pretty much like not setting a stop loss at all, okay? So anyway, only use a mental or manual stop loss if you do have the discipline, or if you really, really, really don't want to set a stop loss on the platform for some reason. Okay, so that's one consideration, initial stop loss. Number two is your initial profit target. Again, you could set it on your platform, or it could be manual. Okay. Now, for the profit target, oftentimes I will not set a profit target in the beginning. Okay, I will not set one on the platform. I'll use a manual profit target. Okay, and for many reasons, and I'll show you this in a minute. But mostly it has to do with the fact that what I'm trying to do is I'm trying to lock in my profits and not necessarily set a certain point at which I take all my profits. Okay. So most of the time I will not set an initial profit target, but a lot of people do. And you could do this, you could set this initially, or you could, set a certain point at which you want to take your profit. Okay, and then we talk about dynamic or trailing stop losses, okay? And this is a very useful method for locking in your profits. A lot of people use this, but a lot of people don't. So, I think if you're not used to using the trailing stop loss, and when I say trailing, it could either be automatic or it could be manual. What I usually do is I use a manual trailing stop loss. Okay, and I'll show you that in a minute. And then we talk about multiple positions. What I mean by this is you're using, oftentimes what I'll do is I'll put into a trade, instead of putting one big position in a trade. Let's say I'm going short euro dollar. Okay, if I'm going short euro dollar, a lot of times I'm not going to put in a big position. I will break it up into 3 different positions, for example, 3 different smaller positions. Okay, and then go short on euro dollar, and then I'll have the stop loss all the same on those 3 positions, but I will take my profits at different levels in order. This is again in order to lock in profits. Okay, and I'm going to talk about this in a minute as well. And then another or the last consideration that I think of when I'm planning my exits is the reward to risk ratio, and this is basically how much profit in comparison as a ratio to your risk. Okay, so for example, If you are looking for, if you have a certain stop loss, let's call that X, okay? If you have a certain stop loss is X. Now, what are you looking for in terms of your profit? And hopefully it'll at least be the amount of X or more, okay? And I talk about this a lot. I usually look for my profit targets to be a multiple of my losses or of my risk, okay? So in terms of that, let's say my loss is X. Then oftentimes if I'm trend trading, I'll look for a 3X profit target, which means my profit target is 3 times my loss. Okay, this is only if I'm trading longer term position trading, trend trading. Okay, when I'm on a shorter time frame, when I'm swing trading, or if I'm even intraday trading, I may take it down to 1 to 1, or even a little bit higher, maybe 1.5 to 1. It simply means that you want to keep your profit targets larger than your risk. Okay, so that you could afford to lose a lot and still be consistently profitable, if that makes sense. Okay, so reward to risk ratio is another consideration. I'm going to talk about that in a minute as well. So these 5 different exiting considerations should be very important and very, should be foremost in your mind when you're looking to exit or looking to plan your exit from any position. Okay, so what are the trade entry and exit principles that I always talk about? And I always show this slide. I've shown this for many different webinars, but this is my underlying. These are my underlying principles, and it includes the exit principle. Okay, so one way to enter a trade, I talked about that last week. The right direction of the best possible price, which is usually in the direction of the trend after a pullback or after some kind of correction or what have you. Okay, now this is the important part. 2 ways to exit a trade. For this particular webinar, we're talking about exits. So at a loss is where the market is telling you that you're wrong. Okay, and I'm going to show you exactly what I mean by that in a second. If at a profit, what I just mentioned, preferably at a multiple of your defined risk. So you want your profit to be at a multiple of your defined risk on an on an average ongoing basis, so that you could have a less than 50% trade success rate and still make money. Okay? If you're at 1 to 1, let's forget about the spread and everything, but let's say you're at 1 to 1 reward to risk ratio, which means each profit on average is equal to your risk on average. Then you need to have a trade success ratio above 50% in order to make money at all. Okay? Now, if your profit is larger than your risk, let's say it's 1.5 to 1, or 2 to 1, or 2.5 to 1, or 3 to 1, or what have you, okay, then you could afford to win a lot less than 50% and still be consistently profitable. So that's what I'm talking about here in terms of the exit principles, okay? So loss where the market's telling you you're wrong, profit preferably at a multiple of your defined risk, but also keep in mind that 1 to 1 is also a multiple. Okay. Now, I talked about this all the time too, just to illustrate it, okay? The T.P.B. trend pullback breakout. All it means is that you're looking for a trend, you're looking for a pullback, you're looking for a breakout after the pullback, a recovery of the pullback. Now, where does the exiting come into play? Right here, with this red line right here, okay? That is your initial stop loss. And this is the market telling you that you're wrong, because after this pullback, this low of the pullback is established, okay? After it's established, then we're entering on this blue line, this breakout. Once that occurs, okay, we know where the low of the most recent pullback was, okay? We know where it was. It was right at this point right here. So after it comes back to the upside, it recovers from the pullback and breaks out, we get in, and then we know where the low of that most recent pullback was. It's right here. We placed our stop loss directly under that, okay? You could use a filter. For example, you could, do, depending on your time frame, your market, what have you. If you're on a, let's say euro dollar, let's say, I don't know, a 5-minute chart, it could be a couple pips right there as a filter underneath that low. Okay, it could be that. It really depends on your time frame, your market, what have you. But essentially, that's where you place your that's where you would place your stop loss, whether it's a mental stop loss or a set stop loss on the platform. Okay. Now, some people may say, you know, how do you know that's the low of the pullback? Well, that's the low of the most recent pullback. If after you get in, it pulls back again, okay, well, first of all, you're going to get out of that trade, because that trade, the price is telling you that you know, you were wrong in that trade. That wasn't a pullback. It could be a deeper pullback, or it could be a reversal altogether. At that point, you're out of the trade with a small loss. Okay, so you want to have your stop loss where the market's telling you you're wrong. The market's telling you you're wrong when that pullback that you thought was a pullback is shown not to be a pullback, and at that point, you're out of the trade. Okay, no regrets. You're out of the trade. Now, at that point, if it goes further, then the other exiting aspect of this is the reward or the profit. Okay, and in these cases, and I'm going to show you some techniques that I use for this, but in these cases, I'm generally looking for my reward to be a multiple of my stop loss, which means, you know, again, if I'm trading with a trend, if I'm trading in a position trade, I'm going to have a higher reward to risk ratio. Oftentimes, I'll have a 3-to-1. Sometimes I'll have a 2-to-1, and then for shorter term swing trades, I'm going to have lower than that, okay? But generally speaking, I want it to be higher. I want the reward to be as high as possible in order to take advantage of, you know, of the pure math involved. John, do you take complete profits off the table when you reach your profit target? Great question, John. Do you take complete profits off the table when you reach your profit target? Yes and no, okay? Yes and no. Why do I say that? Well, usually yes. But when I am using multiple positions, which I just mentioned a little while ago in this webinar, and I will talk about a lot more in a few minutes, but when you use multiple positions, what you could do is take your profit off at different levels of profit, and that's a way to lock in your profits. And you could use those multiple positions in conjunction with your trailing stop losses in order to put all that together and do the, you know, pretty much the best you could do in terms of managing your trade and locking in profits. Okay, so good question there. Is it Hassan? Is it better to enter after it breaks the previous high? Okay, so this was a question. That's a great question too, Hassan. You know, the question here was if it breaks the previous high, like this one right here, if you could see my mouse pointer. That was last week I addressed this question. You can do this, okay? You can play a break above the previous high. However, what I often do is look for a just an indication that this pullback is recovering and turning back to the upside. I'm not necessarily waiting as far as this last high, a breakout above the last high before getting in, okay? I'm looking for indication that the pullback is recovering, and I'm looking for a breakout there, okay? If I miss it there, perhaps I will take a break above the high, okay? So there are several different definitions for breakouts, and this is one of them here, and then this one up here is another one. Let me see if I have. Okay, yeah, this shows us right here. Okay, you know, so I talked about this. I talked about this last week with the entries. So yeah, you could wait till there's a breakout above this last high. Okay, you could do that. You could certainly do that, and a lot of people do. But you know, what I often do is I look for a reason to get in a little bit earlier, and this, in this case, would be this is a counter trend resistance line. Okay, so this is first we're looking for the trend. We're looking for the pullback to the line. Okay, that's the pullback we're looking for. Then we're looking for a recovery of the pullback, and that's in the form of this breakout above this counter trend resistance line. That's my breakout. Could I have waited till the breakout above this last high? Absolutely, yes, I could have. Okay, it would have gotten me in later. It would have still worked. It would have gotten me in later. Okay, and it would have given me a worse risk management profile, okay? Because if I got it up here and my pullback was down, if I got them up here, which is the equivalent of this high up here, okay, and then my stop loss was all the way down here, that's a larger stop loss, okay? I want to get in with as tight a stop loss as possible, which means as close to my entry as possible. I'm sorry, I want to get in as close to the stop loss as possible in order to have that as tight a risk as possible. Okay, Tim, what percent of your equity do you risk per trade? That's a great question as well. What percent of equity? It really depends on what I'm trading, okay? But generally speaking, I like to keep it under 2%. I know a lot of people have heard this before. Now, when I talk about 2%, okay, what do I mean by that? Do we mean that the margin you put up is 2% of your equity? No, it does not mean that. What it means is that your stop loss, at least your initial stop loss, the amount you can lose on the initial stop loss is less than 2% of your account equity. Okay? So that means that let's say you have 10,000 pounds in your account. Okay? Now, on each trade you make, you don't want your stop loss, your initial stop loss, to represent more than $200. I'm sorry, 200 pounds in your trade. Okay, so you don't want it to represent more than 200 pounds if you're playing with this method. And I think this is a very good method to work by. Okay, you want to have your trades small. You might want to have a lot of trades, but you want to have smaller trades, and hopefully as diversified as possible. Okay, in order to avoid the risk of catastrophic loss. Of course, we always want to avoid that risk. Okay, so generally speaking, I keep it even lower than 2%. I'm going down to 1%. You know, if you talk about institutional traders, it's way lower than 2%, even lower than 1%. Okay, but for retail traders, you know, I know a lot of you like to, you know, take risks, but really, it's not very prudent or wise to be taking, you know, undue risk on your account for no reason. So yeah, under 2%, great question there. Okay, so let's talk about trade exit techniques. So what are the techniques we use to exit trades? Well, first of all, we place our initial stop loss above or below the most recent significant resistance or support level. Okay, so what exactly does that mean? Let's take a look here. This is the same chart from last week. I'm just showing to you for convenience purposes. This happens to be the euro against Australian dollar, which I don't even trade. But the thing here is that you know, again, these exit as well as the entry techniques I talked about last week. These exit techniques work on any market that you want to trade. Okay, they are universal entry and exit techniques that I talk about. Okay, and I use the same entry and exit techniques for every single market that I trade. Okay. This can't be said for a lot of strategies that I use. Some